Your savings account is lying to you, not loudly, not in a way that shows up as a loss on your statement, just quietly, every single month, while you feel responsible and disciplined and ahead of everyone around you who isn't saving at all. The bank is taking your money, going out into the world and making 20% with it, and then coming back and dropping a few cents in your account like that's a fair exchange. And the most dangerous part of this whole arrangement is that it's designed to feel completely normal. I know because I did it for years without blinking. I was moving money into savings every month, feeling proud of myself, until one evening I actually stopped and looked at what the bank had paid me in return. 11 cents. On thousands of dollars. A whole month of my money working for them, and my cut was 11 cents. That was the moment I started asking questions that changed everything. And by the end of this video, you're going to have the same answers I found, plus exactly what to do about it. I'm going to show you how the savings account was designed, who it was actually designed to benefit, the real math behind what it's costing you over a lifetime, and the specific moves that changed everything for me. Don't go anywhere, because there's a number I'm going to show you in the middle of this video that is going to make you want to get up and open a new account before we're even finished. Let me start with something nobody ever explained to me, and once I understood it, I couldn't unsee it. When you put money into a savings account, most people picture it sitting in a vault somewhere, safe, waiting, like a box under a bed but with better security. That mental image is exactly what banks want you to have. The marble buildings, the serious logo, the language about security and trust, all of it is carefully constructed to make you feel like your money is resting comfortably somewhere until you need it. But that is not what is happening. Not even slightly. The moment your deposit lands in that account, the bank puts it to work. They take it and they lend it out to other customers. Mortgages, personal loans, car financing, business credit lines, and most profitably of all, credit cards. They are in the business of borrowing money cheaply and lending it expensively. And you, with your savings account, are one of their cheapest sources of capital. The average credit card interest rate right now is sitting above 20%. Some cards go higher, 24%, 27%, even 29% depending on the borrower. The average personal loan runs between 10% and 28%. Mortgages sit somewhere between 6% and 8%. And for all of that lending, for all of that interest income flowing into the bank every single day, what do they pay you for making it possible? The national average savings account rate at the major banks sits at 0.01% per year. On $10,000, that is $1. $1 for an entire year of access to your money. $1 while they potentially generate hundreds or thousands of dollars in interest income using that exact same deposit as their raw material. I remember doing that calculation for the first time and just sitting there, not angry yet, just genuinely confused. How had I never thought to ask this before? How had I moved money into this account month after month, year after year, and never once stopped to ask what I was actually getting in return? The answer, when I finally found it, was uncomfortable. I hadn't asked because nobody had suggested I should. Everyone around me had a savings account. Every financial tip I'd ever heard mentioned saving money. The habit was celebrated. The destination was never questioned. And that unquestioned destination was making someone very wealthy. Just not me. Here's the part that took me the longest to fully absorb. Because even after I understood the 0.01% problem, I still thought, well, at least my money isn't going backwards. At least the number isn't shrinking. And then I learned about inflation, not the textbook definition, the personal, uncomfortable, practical reality of what inflation actually does to money sitting still. Every year, the cost of living goes up. Groceries, rent, transport, medicine, school fees, everything costs more. Not always dramatically, sometimes just a few percent, but consistently, year after year, the same amount of money buys a little less than it did 12 months ago. The historical average in the United States runs around 3% per year, which means if your savings account is paying you 0.01% and inflation is running at 3%, your money is losing roughly 3% of its real value every single year. Not on paper. The number on your screen stays the same or nudges up by a few cents. But in terms of what that money can actually do, what it can pay for, what emergency it can cover, what life it can fund, it is shrinking quietly, invisibly, every month. I did this calculation on myself once. I looked at what a specific amount I had saved 5 years earlier was actually worth in real purchasing power at today's prices. The number on my screen had grown by a little. The bank had paid me my pennies faithfully. But adjusted for inflation, I effectively had less than when I started. 5 years of discipline, 5 years of consistent saving, and I had gone backwards in real terms. That was the moment it stopped being an intellectual exercise and became personal. I hadn't been saving for the future. I had been preserving the illusion of saving while inflation quietly did its work on the other side of the equation. Now I need to tell you about the other side of this story, the side that made the 11 cents hit even harder once I understood it fully. The same bank paying me 0.01% on my savings had a credit card product sitting right next to it it on their website. Same bank, same institution, same logo on both products. The savings account paid me 0.01%. The credit card charged 22.99%. Think about that spread for a moment. They borrow from you at essentially zero. They lend to someone else at 23%. The gap between those two numbers, that difference, is captured as pure profit, collected every day from millions of accounts, in every economic condition, whether the market is up or down, whether their customers are thriving or struggling. And here's the structure that makes it so effective. Most people are on both sides of this transaction simultaneously. They have a savings account earning almost nothing, and they have a credit card balance costing them a fortune. The bank is winning twice from the same customer, getting paid to hold your money on one end and getting paid to lend it back to you on the other. I was that customer for longer than I want to admit. I had savings sitting at 0.01% while simultaneously carrying a credit card balance at 19%. The math on that situation is genuinely painful to look at directly. My savings were earning $1 per $10,000 per year. My credit card debt was costing me roughly $1,900 per $10,000 per year. I was losing nearly $1,900 a year in net interest, and I had money sitting in a savings account the whole time that could have helped fix it. Nobody explained to me that those two products were connected. Nobody sat me down and showed me how the numbers interacted, because the bank had no incentive to. And that's the core of what I mean when I call this a lie. Not that the numbers are hidden, but that the system is designed so that most people never think to put them next to each other. Okay, here is the moment I promised you at the beginning. The number that changes how you see this. I want to show you what the same savings habit produces across 3 different accounts over 35 years. Same person, same monthly contribution, same discipline, just 3 different destinations. Take $300 a month starting at age 28, saving consistently for 35 years until retirement at 63. In a standard savings account at 0.01%, you end up with roughly $126,000. 35 years of consistent saving, and you end up with almost exactly what you put in. The bank's contribution to your retirement, after 3.5 decades of holding your money and using it to run their business, is essentially zero. Now move that same $300 a month into a high-yield savings account paying 4.5% annually. No stock market, no risk, no complicated strategy, just a different type of account that pays you something approaching what your money is actually worth. After 35 years, you have $276,000, more than double, from the exact same habit, simply by choosing a different container. Now take that same $300 a month and put it into a simple index fund, one that tracks the broad stock market and has existed for decades, averaging a 7% annual return. After 35 years, you have $473,000. Let me say that again, $126,000 versus $473,000 from the same monthly contribution over the same period of time. The difference, $347,000, was not created by working harder, earning more, or making clever investment decisions. It was created entirely by understanding that different money has different jobs, and by putting each dollar in the account that matches the job it needs to do. That $347,000 is what the savings account lie cost the average person. Not in a dramatic moment, not in a single bad decision, just steadily, invisibly, month after month, across an entire working life. Now, I'm going to address the thing you're thinking, because it's the same thing I thought, and if I don't address it directly, you're going to finish this video and not do anything. The stock market is risky. What if it crashes? At least my savings account doesn't go down. You're right, a savings account is stable. The number doesn't go red, and I'm not here to tell you to take your entire savings and throw it into the market tomorrow. That is not the move, and it was not the move I made. But I want you to sit with this question. Risky compared to what exactly? Because keeping money in an account earning 0.01% while inflation runs at 3% is also a risk. It just doesn't look like one. There's no red number, there's no dramatic drop, there's just a slow, steady, invisible erosion of purchasing power that continues for as long as you leave things unchanged. And in my experience, the risks that don't feel like risks are the most expensive ones, because they never create the urgency to do anything differently. The market has crashed many times in my lifetime, badly sometimes, and every single time it has recovered. Every single time it has eventually gone on to reach new highs. The people who lost permanently were almost always the people who sold at the bottom, who panicked when the number went red and locked in their losses. The people who simply left their monthly transfers running, who kept buying through the dips without looking, who gave the math enough time to work. They came out the other side in an entirely different financial position than where they started. Time is the most important ingredient in investing. And unlike money, time is the one resource you genuinely cannot get more of later. The best moment to start is always the one you're currently in. So let me tell you specifically what I changed. Because when I finally understood all of this, I didn't overhaul everything overnight. I made a few targeted moves that took a total of maybe 3 hours across a week. And the difference difference they made over the following years was significant enough that I genuinely wish someone had shown me this 5 years earlier. The first thing I did was separate my money into two distinct pools with two distinct jobs. Emergency fund on one side, 3 to 6 months of living expenses, somewhere safe and accessible, no exceptions. Investment money on the other, everything beyond that cushion, somewhere it can actually grow. I had been keeping everything mixed together in one account, which meant my investment money was sitting at emergency fund rates. Separating those two things was the first decision that made everything else possible. The second thing I did was move my emergency fund to a high-yield savings account. This was the easiest change and one of the most immediately satisfying. I found an online bank offering just under 5% on savings, compared to the 0.01% I was getting. Same FDIC insurance protection. Same ability to withdraw anytime I needed. Just a rate that actually reflected what my money was worth. The process took about 20 minutes, and within the first month I earned more in interest than I had earned in the previous 2 years combined at my old bank. The third thing I did was open a Roth IRA and set up an automatic monthly investment into a simple S&P 500 index fund. Not a managed fund. Not something complicated. The most boring, lowest cost, broadest possible option I could find. I set the transfer to happen automatically on the same day each month, so I never had to make a decision about it. I stopped checking it weekly. I stopped reacting to every piece of market news. I just let time and compound interest work on it quietly in the background. The fourth thing, and this one sounds small, but the psychological impact was real. I stopped letting surplus money pile up in my checking account. I used to keep far more there than I needed for monthly expenses because it felt safe and organized. But checking accounts earn nothing. Whatever I didn't need for bills that month, I moved, either into the high-yield savings to build the emergency cushion or into the investment account to let it grow. Money without a job is money-losing ground. None of these steps required me to become a financial expert. None of them required a large amount of money to start with. They required a decision, a few hours of focused attention, and a willingness to accept that the comfortable, familiar thing I had been doing was quietly costing me more than I had ever stopped to calculate. Here's what I want you to take from everything we just covered. At some point in your life, somebody handed you a savings account and told you it was the responsible thing to do. And saving is responsible. Building a habit of putting money aside every month is something genuinely worth being proud of. But responsible is not the same as optimal. And the distance between where most people's money is sitting right now and where it could be sitting, the gap between 0.01% and what is actually available to you, is not complicated to close. It does not require wealth. It does not require expertise. It requires the information you now have and a decision that most people never make simply because nobody ever gave them a reason to. The bank has been collecting on your discipline for years, building their margins on your deposits, funding their credit card profits with your savings, and none of that was hidden. It was always right there on your statement, in numbers small enough to feel harmless. You see those numbers differently now. So here's the one thing I want you to do this week. Not a plan, not a full financial overhaul. One thing. Open your savings account tonight and find the interest rate they are paying you. Write it down, then search for the best high-yield savings account rates available in your country right now and write that number down next to it. Just those two numbers, side by side, with your current balance underneath them. Let that comparison sit with you for 24 hours. Because once you see it, once you make it specific and personal and real, the next step will be obvious, and you'll wonder why you waited as long as you did. The habit of saving is already yours. You built that. Now it's time to make sure the place you're saving into is actually working as hard as you are.